Hello and welcome to a brand new episode of Smart Money. Now, 2023 has started off with the bulls scampering for cover and the Indian market seeing a sharp 1.5% knockdown in the first week of the year. Now, in a year that has begun with many headwinds like higher interest rates, slower growth, big tech layoffs globally and a risk aversion towards risky assets, we try and go back to some basic investing principles to help investors wade through the storm. Joining me today on the show and in the studio is veteran and popular investor Basant Maheshwari. We will be talking about 10 investment lessons that you need to keep in mind in what promises to be a very volatile year. Basant, thank you so much for being with us here. Before I start with the investing lessons, this is a really tough market, right? It seems to be quite tricky. How are you feeling about it?
I mean, we're feeling very bad about the market because whenever you don't make money, you feel bad. Last year has been very bad for everyone, and there's just few guys who would have got it right. But some things in life don't have a recourse. You have to feel bad to feel good. So that's my theory. You feel bad, you lose a sleep once a week, that's fine. Just survive, stay there, you're going to make money again.
So you don't get off the roller coaster, you ride both the ups and the downs is what you're saying. Because, I mean, in a tricky market like this, some people have the temptation to sort of book whatever profits they have, sit on cash. You don't advise that.
If you miss the downside, you will also miss the upside. Because the market is not going to invite you saying that, hey, the party is starting again, why don't you join us? So I've seen so many people who book out early, they don't get back in. So the only option, it looks very difficult, it looks painful, there's trauma, there's pain, there's too much of grief, but that's the only way out. You have to take the pain for the gain.
Okay, so as they say, the darkest hour is the one before dawn, right? But let's start with some themes. There are some basic 10 investment principles that you're going to talk about. And the first one is don't fight the Fed. Now, what do you mean by this? At a time when interest rates are rising globally, what does one do?
So it's been about 30 years since I've been investing, and every time I said, interest rates don't matter, central banks don't matter. And this was the first time when I look back in hindsight, we should have applied a little more mind to what was happening. So in October 2021, when we topped out, you would have seen that the Fed was making some noises about raising rates, not so eloquently as they are doing now. But we said, my company is making money, the EPS is coming, the ROE is there, the cash flow is there, they're giving me dividends, why should I sell them? Now the thing is, EPS is one part of stock valuation. The other part is the price earnings ratio. So when the Fed raises rates all across, your PE gets compressed. So that was the point where your company might still be making money. It might fundamentally be very good, but unless you have a stable environment, the price earnings ratio will tend to compress itself. And the fall that we have seen in the market, especially in the mid and the small caps, relates to a compression of the price earnings ratio. So price earnings ratio is not mathematics, it's more psychology, it's more perception. So that psychology and perception has been hit by the Fed raising rates. And I just want to add one more thing. 3 months, 4 months, 6 months down the line, the Fed will now be cutting rates. At that time, you will say, hey, this company is making losses, why should I buy it right now? Let it report good earnings. So then you will be fighting the Fed again, because the Fed would be cutting rates and you would be looking at your stocks and companies and saying that I can't see the profits, why should I buy them right now? So the big theme is you have to follow the Fed unless you're okay saying that these are my stocks, I don't want to look at the prices of 5 years. Then there's no need for you to worry about the Fed. You can say, I don't care about the Fed. But if you want to look at prices every 5 weeks, every month, every 6 days, then obviously you have to pay attention to what the Fed is doing.
And now that the Fed is hiking rates, at some point the rate cycle is going to turn as well. What is your, what's the most prudent thing to do?
So, I mean, the most prudent thing to do would be to retain your investments and hold on. Now, what would it take for the Fed to actually accelerate the rate cut process? So tomorrow you get a news flash that Barclays is having a problem in Europe. Suddenly the Fed would wake up from their sleep overnight and cut rates by 50 basis points, 100 basis points. So till there is no problem, the Fed would not cut rates. Or if the Dow Jones starts to fall and the Nasdaq starts to fall, it's bad, it's painful, but these are good things for the Fed to see. I read somewhere that the Fed has data for how much money each American has in his savings account. And they keep raising rates till they figure out that we have exhausted all the savings account balances to that level, which means that the guys can't take it anymore. So the Fed is there to suck all the money out from you, and when their data tells them that they have really brought you to the road, that's where they will stop.
Okay. Well, the next thing is when the market falls, earnings don't matter because everything falls. Now, this goes against the basic theme, right? We talk about how every bull market is sort of the bedrock of a bull market is earnings. But you tell us, what is your learning?
So the earnings have a view. So if you have a 2-year view, it doesn't matter. Everything is going to be decided by earnings. But if you want to look at markets every day, every week for 2 weeks, 3 weeks, 4 weeks, then when the market falls, everything falls because just as I said, the price earnings ratio compresses itself. So say a stock with a 10 rupee EPS trades at a 20 P, it's 200, and when the P comes to 15, you still have a 10 EPS, but the price is 150, and you're calling up people to figure out, bhai hua kyun, gira kyun? Gira isliye because there's a P compression. So when the market falls, everything tends to fall, and that's the problem which we don't understand, and we take a lot of time to understand because we want a logical reason for every price move, and every price move doesn't always depend on logic. It depends on too many other things also.
So what do you do at a time like this? To give you an example, right? I mean, technology stocks, great companies, super managements, they've lasted for over decades. But this year, the year gone by has been pathetic, down 20-30%. But the global tech market has also fallen. So what do you do at a time like this?
So I'll give you a thing which we've researched and we saw. Stocks don't fall more than 60-65%. A few of these tech names have went down 50% and then they stopped. So at 60-65%, unless the company is folding up and heading itself into bankruptcy, every stock tends to turn back 60-65-70%. And the logic there is, I mean, if you look at it globally, Meta fell 70%, it recovered back. Adobe fell 70%, recovered back. Netflix fell. In India during the COVID times, Bajaj Finance also fell and it recovered back. So beyond a point, stocks don't fall. So that's what you have to keep in mind. And if you think that America is not going to be in a recession for 20 years like Japan, obviously you have to buy the tech names.
Okay, so that brings us to our third investment principle, that companies with good earnings always bounce back. Do you think IT is a good example there? Because the earnings have been good, but perhaps not as good as what the street was estimating, right? There is a slowdown in growth. So how does this sort of corroborate with that?
The fall in the IT stocks has been because their EPS hasn't gone down. The price earnings ratio has compressed itself because of so much of chatter around the world about recession and global slowdown and things like that. And the thing is, if a company's EPS doesn't fall but grows 10-15%, then stocks normally see their all-time high between 12 to 18 months of that. You can go and backtest this. So if my company's EPS is not falling, the earnings are not falling, and like we suggested and we discussed a few minutes back, that in the long run, it's the earnings that takes over the entire thing, then obviously the earnings are going to rule the roost for the next 12 to 18 months. But you have to have staying power for that. If you buy a stock and it falls 3%, 4%, 5%, you won't get a reason. There are no reasons in this market for day-to-day movements. We create reasons. While you're in the newsroom, you will have to look at reasons because your viewer wants to look at the reasons.
That's my job,
but
right?
There are yeah, absolutely. But there are no reasons for day-to-day moves. So that's the way to look at it, that if the EPS comes through, all stock prices will reclaim their all-time highs. But if the EPS doesn't come through, I mean, Infosys from a 300 PE took 6 years to recover back the entire money, but at least you recovered it back. And 300 PE Infosys had when it was not paying taxes because it was under the tax holiday scheme. So basically it was effectively 400-500 PE in the year 2000. So even a company with 300-400 PE gets to take out its all-time high in 6-7 years. So if you can hold on, I mean, you will make money.
Okay, so let me just try to play the devil's advocate here, right? You're saying that companies with good earnings will bounce back. What do you do with some of these names, say the new age tech companies, the Swiggies, I mean, in the listed space, the Zomatos, Nykas of the world, right? They're promising a return to profitability. They haven't displayed it just yet, especially names like Zomato. Then there are these huge large-scale layoffs at the company. But there is a hope of profitability. What do you do at a time like this?
See, these are new age tech companies who have long distance earnings. So they are promising you of earnings about 2 years, 3 years, 4 years down the line. Even a stock like Nykaa, for example, a stock like Paytm, for example. Right now, if I can get a profitable company at a 12-15 PE, nobody, see, environment is not about risk. This environment is about being risk averse. So these companies will not do well right now, but when the Fed cuts rates, these will be the ones to recover back the fastest. But then it's very difficult to make money in those kind of companies. And this time, when the situation is a little uncertain and a little foggy out there, I would suggest that people should back up companies which are showing earnings rather than try to back companies that are showing promises.
Okay, so stick with companies that are showing true earnings, factual earnings, rather than just the hope of profitability. So perhaps be cautious on these new age tech companies. All right, got that. The next one, stocks can fall without logic because someone else is on a margin or leverage. So this is more to do with some of these trending stocks, as we call it, right? What does one do here? There's sometimes no logic on the way up and on the way down. What do you do?
So margin is more of a cascading impact. It's like the cycle stand syndrome that I say. You push one cycle and there are 20 behind it, and you suddenly find 21 cycles falling, because when a price falls, X is on margin, he sells, and because X sells, price falls further and he instigates Y to sell and Y instigates Z to sell, because every fall in price instigates and creates this margin issues. So when you have a stock like this, first is for a retail investor, he would never know whether it's falling because of a margin call or whether it's falling because of an earnings disappointment.
You want to give us some examples?
So I can give you an example. For example, Bajaj Finance, which we would own in a small case, reported very good earnings. There was no problem with the earnings, but the 27% growth. But then people figured out a way to say that these earnings are not good enough. Why? Because the number of new loans hasn't gone up. So the stock fell. So when a stock like that falls, and these margin call selling normally happens in F&O stocks. So when a stock falls, it creates panic and the others sell, and when everyone starts to sell, it falls even more. So these are times where you have to, if you own Bajaj, for example, no recommendations,
sure,
you have to look at the company and say whether these earnings have met your expectations. If they have met your expectations, you are fine, because somebody else is selling because of the price, but you are holding the stock because of the performance of the company. So the distinction has to be made.
Okay, that's a very important point actually, because a lot of people have faith in the company, in the management, but sometimes growth rates also come off, right? Which is okay, I guess, but that also leads to PE compression then.
Absolutely.
What do you do at a time like that?
See, you look at it this way. Say you got an uncle who's got a store in Chandni Chowk, and you call him, "Bikri kaisi chal rahi hai?" And he says, "Eid ki sale utni achhi hui nahi." So Eid ki sale achhi hui nahi means you couldn't sell well on Eid, there was no demand on Diwali. Does it mean he shuts his shop down? Recession is just like that. 1-2 quarters, people couldn't sell, people couldn't buy, somebody was knocked out of a job. Bad, we feel bad for that guy because it's not me. I can just talk about it and move on. But recession is not life and death. Recession and booms, these are basic capitalistic features. So when these things happen, you should have staying power in the market. When I mean staying power, it doesn't mean that you should not be in margin, but it should not be, you should mentally be focused that I have to survive these times. So the problem is, if you own a stock, let's say for example, you own an Ultratech and it's at 7,000 and the price falls to 6,000. The first thing is either your kids or your dad or your spouse will tell you, "Ye kya kharid ke rakha hai, isko becho." Whatever money is left, you take it out. Then there's added pressure at home. Then when you go out, your friends will tell you about it. But if you have held on to a company with a 5-year view, with a 3-year view, these things will come and go. Easier said than done. Because even when my stocks fall, I call a couple of people and say, "Koi khabar hai kya isme gira kyun hai ye?" But that's a part of life. You have to carry on with that.
Okay, ups and downs are a part of life and part of the equity markets, right? Got that. Very important life lessons and investment lessons. So we'll take a quick break. Don't go anywhere. We'll be back with Basant Maheshwari in just a bit with the 10 top investment lessons for 2023. Stay tuned. Welcome back to Smart Money. This is our New Year episode where we're talking about the 10 investment lessons that you need, especially in a volatile year like this one, for 2023. We have Basant Maheshwari, author and portfolio manager at Basant Maheshwari Wealth Advisors, and he has very helpfully talked about, some investment lessons. So let's move on. Basant, the next investment lesson that you speak about is every stock has its day. And if we go, you just take an example of the last year, I think the day and the year belong to PSU banks, right? After what, over a decade, they started to perform. But how do you decide when the party is over?
See, I think I have a different theory on this. About 30 years back, when we started investing, when Hindustan Motors, the company is shut down, it used to make ambassador cars. When it used to rally, we used to say the bull market is nearing an end. 10 years back, when Suzlon and Unitech and HCC and Nagarjuna and IVRCL used to rally, we used to say maybe the market has topped out. I don't know, I don't want to put my neck out, but the way these PSU banks were going up, none of the guests on your channel could actually defend them fundamentally. All they said was they haven't gone up for 5 years, so suddenly they are going up. And all these second line, third line PSU stocks that were going up, I don't know whether they had a message for us saying that right now you guys are making money, but just be careful, this bull market is wanting to take a breather now.
Are you saying that because you missed out on the rally?
Of course I missed out. Of course I missed out. But then...
Is it a case of sour grapes then?
Obviously it is. But then when stocks like these actually go up, where you cannot fundamentally justify them, that is happening there. And say with PSU banks also, even if you had them in your portfolio, they would have been 3, 4, 5%, not enough to move the entire portfolio. So, but every stock, if you survive the game, if you hold it, you will make money. So PSU bank has to be distinguished. And SBI is not a normal PSU bank. That's a class A, a category A bank. But the second line and the third line banks, the third line stocks, when they start moving up, it tells you that there is a danger level somewhere.
And it's okay to miss out on the rally, right? I mean, there's so many fish out there in the sea. You don't have to eat every single one of them, right? Got that. Let's move on. Popularity loses. Now, what do you mean by this? You talk about how fancied high PE stocks held by large funds didn't outperform HDFC Twins, paint companies, strong brand with moats. It's interesting, right? Because these are the companies that are performing well on the earnings front, but are not doing anything in the stock market.
Say, if you have an 80 PE stock with a 15% growth rate, right? And the stock doesn't do anything, it takes 7 years for the PE to come down to 30. So from 80 PE, you cannot justify it at 70, 60, 50, 40. Moment it comes to 30 PE, then you start justifying it. So there are some stocks, they keep moving till they don't keep moving. These are one of them. And when I say popularity loses, I mean, investing is not as easy as a beauty contest. In a beauty contest, popularity wins. But in investing, if a stock is popular, and everybody knows about it, then it's very difficult to make money out of it because here the unpopular stock wins. So what are the big multi-bagger themes that actually make money for people? Say if I want to buy 1,000 shares of a stock and I have to bid the price up by 1%, it means it's unpopular. So when I used to buy Page about 10, 15 years back, for me to buy 500 shares or 1,000 shares, I had to take the price up by 3, 4%. So when a stock is very, very illiquid, it's telling you it's not popular. When a stock is very liquid, it tells you that it's popular.
So what are the unpopular stocks? I mean, these are not recommendations, of course, but what are the unpopular stocks which are delivering on growth, which have valuation upside, but are just sort of undiscovered by the market?
No, but I can take you back in history. So there was a stock called Symphony. I didn't own it. So you had to take the price up by 10% to buy some decent quantity of that stock. So if you find a stock like that, if it's a consumer business, if it's growing at 30% and your starting point has to be 10, 20, 30 PE. If you start with an 80 PE, it's like scoring 22 runs in a final T20 over. It doesn't happen. It's very difficult.
Okay, and finally, you have a couple of more themes. Let's run through them very quickly because we don't have too much time. Consensus rarely works because everyone cannot be rich at the same time.
Right. So let's take the example
again. Give us an example.
So let's take the example again. Suppose that let's go back into the past and say we are at 2010 and everyone here owns the stock Symphony. I can talk about it because it's not a recommendation. So at that time it was supposed to be one of the good stocks to own. And if everyone owns Symphony or everyone owns Titan and the price doubles up, where is the next buyer going to come from? Because everyone has already bought the stock. So the consensus never wins because at every price point, even as the stock keeps moving up, you need a new set of buyers to come in. And if all the buyers have already bought the stock, and that's the problem, Sonia, when you tell me to talk about stocks on TV, and if I talk about a stock on TV, I naturally tell everyone to buy it. And if everyone's bought the stock, and let's assume the stock goes up 50%, where are you going to get the next set of buyers from? So you want to own your stock, not talk too much about it, and then hold on to them.
Okay, information is democratized, causing volatility. Now, an overdose of information in today's day is a given, right?
Right.
WhatsApp, TV, social media, Telegram. How do you cut the noise?
So the only way to cut the noise is to extend your holding period.
Okay.
Because if you have a smaller holding period, the noise is going to cut you both ways. It's going to go up, it's going to come down. So from June 2022 to October 2022, in 3-4 months, the index rallied at least 3,000 points. And no one knew why it's going up. And index also fell like that. So the problem with this kind of information is everyone gets all the information within a period of say 30 minutes or 20 minutes, and everyone looks at the same exit door and everyone wants to get in through the same entry door. And that's the problem with information. But this information is there for sure. It cannot go away now. It can only increase. So the only way to get out of this is to extend your holding period.
Okay, extend your holding period. That's the only way you can cut the noise. Got that. Money can be made by short-term trading, but wealth creation needs long-term EPS growth. I think that's a given, right? I mean, that's kind of something that everyone knows about.
Everyone knows about, but in this kind of an environment, even if your company is going to grow EPS by, say, 25% every year, and there is so much of noise all around, you would want to sell the stock and say, I will buy it back later when there is clarity. So when there is clarity, आपको भाव भी clarity के देने पड़ेंगे. You will not be invited for this party by a prior invitation, and that is why if you are sure about your company that it's going to grow earnings, let the other guy make some extra money by trading. Let the entire world make money, but you have to stick to what you know. And if your company delivers on earnings, you will get your price back.
Okay, now that the lessons are over, before we end the show, I know you don't want to talk about stocks, but give us some themes. What do you think the big trend, the big theme will be in 2023?
So the big theme, the trigger for all the themes is the Fed interest rate. If the Fed sticks to its higher for longer policy, 2023 is going to be a damp wicket for you to bat on. It's going to be very difficult. You have to just think of surviving. But my sense is, and the general consensus is, that the Fed might want to lower the rates, and the moment the Fed decides on lowering rates, there'll be an all-round rally, starting from the consumer discretionary, starting from IT services in India, starting from maybe a cement companies, because their input costs will go down. So, for example, if you want to buy a stock, so then you will be confused whether should I buy Dalmia cement or an Ultratech or a Shri cement. So my bet would be to buy an Ultratech, not a recommendation. I will tell you why. Because Ultratech is more widely bought. When the foreigners come into India, they would like to pick up Ultratech. So you would be confused between NBFC names. Blue chip stocks, they rally the first and they rally the fastest. So these are the kind of companies you should normally bet on, because when the rally starts again, and it is going to rally. So this is the only game, Sonia, where you win by surviving. The other games, whether it's football or hockey or cricket or maybe a casino, you don't win by surviving. You win only by winning.
Yeah.
So this stock market is a place where you can win by just surviving. So people should think of surviving with their demats loaded. You cannot empty your demat. So that means you've left the game. If you lose, if you leave the ground, how can you win the game?
Okay, this show was truly dripping with a lot of investment advice and, sane advice at that. Basant, thanks a lot for joining in. Hope you have a great 2023.
Thank you.
Hope you don't just have to survive, but you make a lot of money this year.
And I would like to add, it's easier for me to say, but even we get swayed by prices on the screen. But then you hold yourself back and you say, I have to survive. That's it.
Okay.
This too shall pass.
As long as you continue watching the screen, I'm fine with anything. Thanks a lot for joining in. Really entertaining infotainment, as we call it. A lot of information, a lot of entertainment. Thanks a lot. With that, it's curtains down on Smart Money. Thanks a lot for watching.